So can you guys see my screen? Okay, I'll take that as a yes. So, good afternoon and welcome to the Hoperation Fund month report for the beginning of March. Today, I'm gonna go over our portfolio report, market analysis, and then I will share a new announcement. Finally, I will move on to our open discussion and share where we will share our ETF portfolios from a few classes previously, and as well as continue onto our finance and investment lecture. So the return in February was negative 1%. In February, SPY and QQQ both had losses of negative 1.27% and negative 2.7%. The 1 point, and negative 2.7%. At the beginning of February, we earned $1,200 from fundraising activities and gathered $61 in membership fees. I also gifted $50 for our invited speaker, as well as donated $244 to nonprofits that donators specified. So in February, I sold BODR, ANET, and other short-term traded ETFs and reduced shares of technology stocks. With some of the remaining money, I purchased NVO with 1% capital. So NVO is a high-quality pharmaceutical company in Europe, and in September 2024, I we originally had NVO, but I sold it at $130 a share. Recently, though, I found that its price has become reasonable, so I purchased it back at $89 in February. I also increased shares of existing insurance stocks, finance stocks, and healthcare stocks. And as of now, we have 16% of cash. Below, I plotted the monthly returns in percentages of the Hoperation Fund, SPY, and QQQ. And here is the monthly returns. Note that the total return since the beginning of the Hoperation Fund in June 2023 was 75.8%. In 2025 so far, we have had a return of 0.74%. Okay, so now let's continue on to our market analysis as of February 28th, I think. The market direction right now for midterm is neutral but leaning towards bearish. However, the long term is still bullish, although slightly neutral too. If you're wondering, the market direction is based on a long-term investment model of the Hoperation Fund. And if you want to know more about that model, you can click this link here or go to our Hoperation Fund website to the blog page. And recently I posted a quick 2-minute article about our long-term investment model. So if you're interested, you can, after this class, go to the Hoperation Fund website and just read over that article. Right. So The short-term market sentiment, according to CNN Fear and Greed Index, is now at the extreme fear category, which means that many investors right now are very scared that the market will experience some major drawdowns or like crashes. I would suggest for a pretty conservative position of around 30 to 40% of stocks, 30 to 40% of cash or short-term bonds, and 5 to 10% of gold or other equities. But of course, this is just in my opinion, and it doesn't work for like everybody, so you shouldn't take it word for word. The market valuation right now is overvalued. The S&P 500 PE has decreased a little to 29.79, but it is still largely overvalued, and I estimate it will have a drawdown in the near future of around 20 to 30%. So now, based on our market analysis, where do you guys think we are on our economic and market stages? Do you guys want to like share it in the chat or blurt it out or try to guess? Okay, right now I would say we are leaning toward the end of the bull market. So based on these like recent bearish indicators, I believe that we are we are approaching the market top. So I would recommend exercising some caution. So now, based on the market stages and the economic stage we're in, does anyone want to guess like what sectors you guys think will perform well? Mm. Okay, opposite oil, like the energy sector. Mm. Yeah, that's a good guess. That's really interesting. Does anyone else have any other guesses? Okay, so here below, I inserted a like table of the best sectors that performed the best in the past month, from increasing to decreasing order of like the returns in February. So the top sector was the consumer staple sector, and then real estate, utilities, energy, financial, healthcare, etc. So yeah, uh, I feel like you're pretty close. Yeah. Okay. So next, I'm going to announce a new announcement. So, in the I am excited to announce that I have now made available two vice president or VP positions. So, if you are a Hoperation Fund member, this is a great opportunity to be able to take a key role uh and make a impact in the Hoperation Fund. So one VP position is the VP of Education. So that's responsible for organizing and leading our business reading club and other possible upcoming book reading clubs. This role involves planning discussions, selecting books, and fostering insightful conversations. The second VP position that is open is the VP of Media Design. Mm, The Hoperation Fund hosts a variety of impactful events, such as fundraising events, donations, lectures, and invited talks. So, as the VP of Media Design, your job will be in your job will be or includes designing flyers and posters, editing photos and videos to post on the Hoperation Fund, and developing engaging promotional materials to help our fundraising events. So if you have a passion for design and you're interested in this and you want to like make a difference, this would be a great chance to uh, to take on a key role in the Operation Fund. So we have two VP positions, VP of Education and VP of Media Design. If you're interested in applying for these positions, please send your resume to me through email and I will review your resume, maybe give you an interview, and yeah. Additionally, other VP roles may also be available in the future, so I would recommend like staying tuned and maybe like visit our blog page on our website for like new articles or new news. So that's an exciting thing you can take part of. I really encourage you guys to apply for these positions. It will be a great chance to make like a difference in the Hoperation Fund. So next, let's move on to our investment lecture for today. First of all, I would like to go on to our first. I would like to start our open discussion. So a few meetings previously, I gave you guys a homework to like build your ETF portfolio, and later on we like shared that. Um, so throughout So the purpose of the homework was to like build an ETF portfolio, which we would like share throughout the year, um, in like each meeting, and every meeting, everyone would like talk about their positions or their portfolio, maybe talk about some recent changes they made or interesting things they noticed, about their ETFs, etc. So I will start first. In January, I sold SMH, which was a semiconductor ETF, and used the money to purchase XLV. So XLV is the healthcare sector in SPY, and I thought that sector would experience a lot of growth in 2025, so I purchased it. In February, I also sold IWM, which was a small cap ETF, and used the money to purchase SCHD. I sold IWM because I thought with President Trump's new trade wars and tariff policies, that would negatively impact a lot of smaller cap companies. I purchased SCHD, which is an ETF that selects a lot of stocks with like high dividends and pretty good quality because generally that ETF performs better than SPY in periods of economic recessions. So since I thought that the stock market will most definitely have some minor minor crashes in the near future, I thought that SCHD would outperform SPY if there was like a recession. Okay, so does anyone want to like share their ETF portfolio? first, of course, if no one wants to share first, I'll just like call on everyone from the order I see them. But does anyone like want to like volunteer to share the ETF portfolio um first? Although I'll give you guys like time to go onto your Fidelity or other like stock trading accounts and access their ETF portfolio. Okay, so now I hopefully you guys should already have your ETF portfolios put up. Or if you guys sold them already, then I guess you can just like say maybe what ETFs you chose for your ETF portfolio, and if you had to change your portfolio, what ETFs you would change, or what things you noticed about your ETFs in your imaginary portfolio. So, right now I'm gonna call on each of you guys if no one wants to volunteer. So, okay. Wyatt, so you're the first person I see. So, do you want, so you can like come and share your ETF portfolio. Uh, Wyatt, you there? It's okay though. If you sold your ETF portfolio, you can just say like what ETFs you included in your old portfolio and maybe what you would change if you had to like if you actually bought that portfolio right now, if you wanted to change something. Okay, so it seems that Wyatt is not maybe not present right now. So if not, I'll just like skip him and we'll go on to him later. Okay then. So the next person I see is do you want to like go and share your ETF portfolio?
Um, I recently started and I just invested in XLE for now. I'm still looking at other ETFs.
Oh, okay, that's great. So why did you decide to invest in XLE? Um, was,
Mainly because of the Trump administration and his comments regarding drill baby drill.
oh yeah, yeah. It's like really well known that Trump is very positive on like energy and like oil companies. So yeah, that's really interesting. Thanks so much for sharing. Mm, okay, that's great. So the next person I see is William. Uh, mm, so you can go on and share your ETF portfolio.
Okay, so currently I'm in currently I don't hold that many ETFs. I used to hold a few tech ETFs like XLK and XLK and what is this one? XSW because I thought that the tech sector had high growth, but since the S&P is like currently like retreating from all-time highs, I decided to sell them because I think there might be potentially a market correction. And then I took that money and I transferred that and put that into more stable market-oriented ETFs like QQQ and RSP. So it tracks the overall market growth instead of just the tech because I see that the market is going to correct from the all-time highs.
Oh yeah, that's really reasonable. Yeah, I can definitely see your reasoning for like selling like these technology ETFs, and yeah, I agree with you. Yeah, thank you so much for sharing, William.
Thank you.
Mhm. Okay, so that's great. So now the next person I see is Angela, or wait, is Angela a parent? Hold on. Okay, so Angela, do you want to unmute and share your ETF portfolio with us?
So, I missed the last two times, and so I haven't really done it. So, can you please skip me?
Oh yeah, that's okay. That's okay. Yeah, if you missed the last two meetings, yeah, sure, that's perfectly fine. Um, yeah. However, this is to everyone. If you guys like uh missed a few meetings previously and you guys haven't made an ETF portfolio, that's fine, but I would recommend you make one um after this class because every class this year we will be like reviewing our ETF portfolios and talking about the market. Mm, so the next person I see then is Livia. Uh, so Livia, um, it would be great for you to like share your ETF portfolio.
So I actually haven't checked on it in a long time because like I've been really busy and also missed like a ton of the meetings. But I do have one. I just like haven't seen it.
Oh, that's fine too. Then do you like remember like did you set your account up on like Fidelity?
The what?
Did you set like your investment account on
Yeah, I did.
Oh, okay. So do you remember your Fidelity password?
Um, I could check on it like with my mom, but probably like not right now.
Yeah, okay then. So that's okay. Oh, okay, I'll skip you this time. I'll check with you later to see if you like uh found like your Fidelity account and if you want to like review your ETF portfolio. But yeah. Anyway, so I'll go on to the next person then. So Kai, do you want to share your ETF portfolio with us?
I don't have one right now. I'm still doing research.
Oh, okay, then that's fine too. Then, um, so then Again, I'll probably call on you later. So then, Lauren. Oh yeah, Lauren, are you new to the Hoperation Fund? Because I don't think I've seen you before at previous meetings. Or maybe I'm wrong. Anyways.
I've been to one of the meetings, but not any previous ones.
Oh, okay then. Um, well, do you have an ETF portfolio and do you want to share it? If you,
Yeah, I have AIQ and QQQ. Those are the ones I'm investing in right now.
oh, that's nice. Why did you decide to invest in them?
Well, with AI starting to ramp up more, I figured AIQ would be a good investment because it's AI and stuff, and QQQ is very stable. So I would like to have a stable one and one that's a little bit of a gamble, but it's still I can see it progressing well.
Oh, nice. That's really interesting, Lauren. So thank you for sharing. Um, yeah, I can like see your perspective, and that's like a really interesting like viewpoint.
Thank you.
Okay, so then the next person I see is Sebastian then. So Sebastian, do you want to review your ETF portfolio with us?
I didn't make one. Are you talking about like the one previously that I made?
Oh yeah, that one. If you don't have it right now, like, if you maybe like sold it or anything, then it's okay. You can like just talk about the ETFs you previously purchased, and if you are going to like purchase them now, like what changes you might make, or if you would like sell any ETFs or anything. Mm. So Sebastian, do you like remember any of the ETFs you previously um, um
Not totally. I'm trying to find it.
oh, okay then. That's fine then. I'll just return back to you later. So I think someone was also finding. Okay, so the final person I see today is John. So John, do you want to share your ETF portfolio with us?
I don't have it to share, but all I invested in was VTI
Oh,
so
cool.
far, at least.
Oh, cool. So what was your reason for investing in BTI?
Just wanted to pick some kind of fund to give me solid money and a good stream. So I just did some research on it and saw it doesn't fluctuate super crazy over a couple years. So I just wanted to pick something that was very stable. So that's what I ended up going with.
Oh, that's great. Thank you for sharing then, John. Mm, okay. So yeah, thank you all for sharing. Is there, oh yeah, um I think I was gonna call back on like Kai. So Kai, if you've finished doing your research, do you want to share your ETF portfolio with us? Okay then. So uh if not then I will continue on with our lecture for today. Again, if to anyone who hasn't like made their ETF portfolio yet or who uh kind of for kind of forgot about theirs, then I would recommend like you making it because every meeting from now on this year, we if we have time, we will be discussing about our ETF portfolios, like what were some changes you might have made? What are some interesting things you found? Or what was your reason for investing in this ETF? Okay, so I think Sebastian, you said that you found your ETF portfolio now. Okay, so that's great. So you can go ahead and share yours.
Well, I have. Yeah, wait, how I didn't I have $10,000? Okay, so I basically put $10,000 and uh for I bought some gold at 3 shares.
Well, it's 7%.
7%, yeah, 3 shares. And I bought gold because when like there's inflation, it doesn't like go like get too like it stays the same price. And I also got IBIT Bitcoin 10 shares of that because for the same reason I like to keep it so I don't like lose like value for things when inflation goes up. And then I bought ARK and TLT. And well, I bought both ARKs, ARQQ and ARKK. And then I bought IWM, 15 shares of IWM because I like to have exposure to the market. There's and then I bought 40 shares of TAN, 15 shares of ARQQ and TLT, 9 shares, and then 40 shares of ARKK.
Oh wow, that's really cool, Sebastian. Yeah, I'm glad to see that like you have like so many ETFs and it's it's really great that you shared like your reasons for buying all of those ETFs. And yeah, nice. So thank you guys all for sharing.
Sorry that my brother came and he didn't realize that I was presented.
Oh, that's okay, that's okay. I could like hear you pretty fine. So that wasn't like a big problem. Okay, so now I'm going to like very quickly review bonds from last time. Basically, a bond is a loan made by an investor to a borrower, which is generally a company or a government. A bond is a fixed income investment where the borrower pays regular interest and repays the principal amount that they borrowed at the maturity of the bond. Some important features about bonds are the face value, the coupon rate, the bond price, sometimes called the market price, the bond yield, the maturity date, and the credit rating. Note that the bond yield times the bond price is a fixed value, so it will be inversely related. For now though, I'd say the 4 main features you want to know is the face value, which is the amount of money a bondholder will receive from the bond issuer when the bond matures, and represents the principal amount that the bondholder initially lent to the issuer. The second important feature is the market price. So that's the amount a buyer in the market is willing to pay for the bond. Then there's the coupon rate, which is the interest rate that the bond issuer or borrower pays to the bondholder. And the yield, which is the annualized coupon payment in terms of the coupon rate and face value. So the yield is like a percentage. and can change, while the coupon rate is fixed. So as we know, bonds have different ratings. The higher the ranking, the lower the risk of the bond. So the highest rating, according to like Moody's and Standard and Poor's, is AAA. And then the lowest rating is like C or D. The bonds with the higher ratings are called investment grade bonds. Since they have lower risk, they're more suitable for like the ordinary investor to invest in. And then the bonds with the lower ratings are the junk grade bonds. Generally, bonds with lower ratings have higher returns to make it like more appealing to the buyers. However, they also have like higher risk that they will not pay back the money that they borrowed. So generally, I would recommend investing in bonds with higher grades or higher ratings. There are three main types of bonds: government bonds, which are issued by national governments; corporate bonds, which are issued by companies; and municipal bonds, which are issued by local governments for public projects. For example, a bond issued by Dallas County would be a municipal bond. So why would someone invest in bonds? Bonds have steady income, for one thing. Investors can receive regular interest payment, and this might be preferred for like investors who can't take a lot of high risk, or older investors who are using the money they invest in to for like their living costs. They also have lower risk. They have less volatility relative to stocks, and the biggest risk of bonds is probably that the borrower will not pay back the money that they borrowed. Then there's the portfolio diversification, which is also a benefit of bonds, as bonds can hedge against stocks' risk in some situations and reduce the overall risk in investment portfolios. Some limitations of bonds, though, are that they have lower returns than stocks and are generally not a good investment in high inflation environments. So in high inflation environments, there have usually been positive equity bond correlations. So when the inflation rate is above 3%, bonds have a positive correlation with stocks, and so they can't hedge against stocks. So you might want to take note of that if you're trying to use bonds to hedge against the stock market. Bond prices are also inversely related to interest rates. So when interest rates rise, many investors might choose to put their money in the banks. So then bond prices will fall to make their bonds more, and then since bond prices will fall, the yields from bonds will also rise to make the bonds more appealing to investors. When interest rates fall, then bond prices will sometimes rise, and then therefore their yields will fall. So one thing we haven't talked about before is that different bonds have different sensitivities to interest rates. So short-term bonds with like less than 5 years to their maturity date have low volatility and lower sensitivity to interest rates. Intermediate term bonds with like 5 to 15 years will have moderate sensitivity, and long term bonds with greater than 15 years to maturity will have higher sensitivity to interest rates. Different bonds of like length to maturity also have different yields. At a normal economic situation, the longer the length to maturity, the higher the yield. So short-term bonds with like less than 1 year to the maturity will have low yields, while intermediate term bonds will have moderate yields, and long-term bonds will have the highest yields. For example, on a typical day in a healthy economy, a 2-year bond may offer a yield of 1%, while a 20-year bond will offer a yield of 3.5%. So why do long-term bonds have higher yields? The reason is that long-term bonds are more exposed to like the risk that there might be high inflation, and so then like the bond's yield would go down. Or some investors might not want to invest in long-term bonds, so they can more conveniently like make other investments. So because of these factors, long-term bonds sometimes have higher yields to make their bonds more appealing to investors. A yield curve, then, is a line that plots the yields of bonds that have equal credit qualities but different maturity dates. A normal yield curve in like a good economy or a time of economic expansion will show lower yields for shorter maturity bonds and then increasing for bonds with longer maturities. So like the graph below. However, in some cases, there will be an inverted yield curve. So this yield curve slopes downward with short-term bond yield exceeding long-term bond yields. So it's like the opposite of the normal yield curve. This type of curve usually happens in a period of economic recession or if an economy is in trouble. At that time, some investors who are seeking safe investments might want to have longer dated bonds over short dated bonds because longer dated bonds have higher yields, and then that would bid up the price of long-term bonds and then drive down the yield. So some other reasons that investors might choose longer dated bonds over shorter dated bonds during periods of economic recessions is number one, to lock in higher yields because sometimes long-term bonds have higher yields than short-term bonds. Number two, to have like safety and stability. Number three, sometimes when the price of the long-term bonds go up and their yields decrease, sometimes investors would still want to invest in long-term bonds for like capital gains. Since in economic recessions, the market price of long-term bonds would keep on going up and up and up. Investors would want to buy into those bonds and then sell them at a higher price to earn more money. So this would also keep on driving up the price of long-term bonds. The yield curve receives a lot of attention from economists and those who analyze the financial markets because it is an important economic indicator. Shown below in the graph is the relation is plotted the 10-year bond yield minus the 2-year bond yield value. So let me explain this graph a little. When the value is 0, that shows that the difference between the yields of the 10-year bonds and 2-year bonds are the same, meaning that they have the same yield value. When the value is positive, that means that the 10-year bond yield is higher than the 2-year bond yield. And when it is negative, that shows like an inverted yield curve where the 10-year bond yield is less than the 2-year bond yield value. So you can see in these points circled in magenta, you can see they are where the 10-year bond yield minus the 2-year bond yield value goes from 0 and increases. Then after that happens, there will generally be a period of recession, which is highlighted in red. For example, there was like this recession, the dot-com bubble recession, I guess, the 2008 recession, the recession in 2020. These all followed uh, after after this value went up from 0. So right now, the 10-year bond yield minus the 2-year bond yield value has decreased into the negatives and then broken up from 0. So this is very similar to the events that happened before, and this means that it will be likely that there will be a recession immediately after. So this is for you to like take note because this is again a signal that the stock market will experience a correction in the future or in the immediate future. Okay, so finally, I'm just going to review this. So again, you should understand what you're investing in. So you can think of a stock as owning a piece of a company. Like if you have a company, a stock is like a tiny chunk of it. Like you take its returns and its losses. A bond is basically it's like an IOU. You lend money to a company or government, you receive interest rates, and then you get back the money you lent them at the end. And finally, an ETF is like a bundle of assets you can buy. Like some ETFs are ETFs of stocks or bonds or crypto or other equities. Basically, if a stock is like a small piece of a company, then an ETF is like a basket of different pieces of companies. So what are bond ETFs then? Oh yeah, Lauren, do you have a question?
So if we take a piece of that company, does it benefit the company in any way for us to be having that piece?
It does benefit the company. Like some companies, they they like make stocks and like make that like public so like they can raise money. Because like if you're buying, like they're basically just offering like a tiny percent of their company to you for a price. So they're basically like selling a piece of their company. So like sometimes a lot of companies do that to like raise capital.
Oh, so they're selling it. Okay. Okay. Thank you.
Yeah, no problem. That was a great question, actually, Lauren.
Thank you.
So, what are bond ETFs? Bond ETFs are then exchange traded funds or ETFs, which have a lot of bonds or like a diversified portfolio of bonds. They are traded like a stock or a stock ETF. Some advantages of bond ETFs over bonds are that they have diversification, like they can spread risk across many types of bonds. They have a good liquidity, like they are easier to buy and sell compared to individual bonds, and they have low cost. They have lower fees than actively managed like mutual funds with like bonds. One example of a bond ETF is AGG. AGG, or the iShares Core US Aggregate Bond ETF, is a bond ETF with broad exposure to US investment grade bonds. You can see from these screenshots below that all of your bonds are either AAA rated, AA rated, A rated, or at the most BBB rated. So like their bonds are all good investment grade ones. So below is the portfolio growth of AGG versus SPY. So what are some of your observations? Does anyone want to like just share or like blurt it out? Okay, so basically the main difference between AGG and SPY is that you can see SPY is a lot more volatile. Like it has a lot of like ups and downs, while AGG does have like a little bit of ups and downs. It's overall much smoother than SPY. It also has like lower overall returns than SPY. So it's kind of like a trade-off. It has lower returns, but it also has more stability. So now Wyatt asked the question, he asked, what do you consider when you buy ETFs, both normal or bond ETFs? So you consider a lot of different factors. Like number one, it depends on like your market direction. Like what purpose are you looking for like to buy an ETF? Like is there something that you look for? Like maybe you want oil stocks. So like you buy an ETF that has oil stocks. There's also a lot of other different factors, such as the return of the ETFs, both like normal and bond ETFs, or like the risk of the ETFs. And I can give details about that in the next meeting. Uh, Again, like some other like things you might look for that I look for in ETF, or some of its like metrics such as CAGR, its best year, worst year, max drawdown, Sharpe ratio, etc. But like just a lot of different factors like I take into account. Okay. Another bond ETF example is BIL. So BIL is a Spider Bloomberg 1 to 3 month T-bill ETF. Oh, that's a mouthful. So BIL is a bond ETF that provides exposure to publicly issued US Treasury bills that have maturities between 1 to 3 months. So plotted right here are the graphs of the iShares Core US Aggregate Bond, so like AGG, SPY, and BIL. you can see that SPY has the most volatile graph of them all, and then HG has a slightly more volatile graph than BIL, and BIL is just like mainly very smooth. Okay, so now let's move on to talk about Warren Buffett's 90-10 portfolio. So Warren Buffett's ETF investment strategy is where you take 90% of your portfolio and like SPY, like an index ETF, and 10% in a short-term bond ETF. So you will, at the end of each year, like you rebalance it, of course. So the benefits of the 90-10 portfolio is that it has low cost or management fees. It has a lot of diversification. There is access to the stock market. It's convenient. Like you don't have to regularly check your investment portfolio and see if you want to make any changes or not, because you just hold this for like the long term. And the only thing you really need to do is like rebalance it at the end of every year. There's also a good long-term growth potential and reduced risk since it also includes bonds. So here I included two following articles. I gave you guys the links to this, I think, last class at the end for you guys to like look at these. And so, did any of you guys like read these? If you do, like, you can raise your hand. Okay then, if you guys haven't read this then, I will give it to you guys, like in the chat, and you guys can read this after this meeting, and we'll talk about the 90-10 portfolio next class. Hold on, how do I exit out? Okay. And this. Okay. Okay, so then that, okay. So that will be the end of today's meeting then. Oh yeah, hold on. I think William also asked a question, what is my opinion on derivative ETFs? I think like derivative ETFs are generally like riskier than normal ETFs, and I would recommend having like better investment strategies and like risk control strategies if you're investing in like if you're investing in an ETF, then if I were investing in ETF, my main purpose would be to like minimize risk and be more stable. So I would recommend having like good investment strategies and risk control strategies like over them. If that like answers your question. Okay then, great. So in the chat I copied the links to two articles on Warren Buffett's 90-10 portfolio. So if you haven't read that already, you can read that after this meeting, and we will talk about that next meeting. Okay. Thank you guys and bye. Thank you all.
Thank you so much.
Thank you.